Hey everyone, welcome back to Corporate Decoder. Today we are diving into a financial report that's a bit like a roller coaster, filled with twists, turns, and a few unexpected drops. Get ready because it looks like this company is trying to turn clean energy into green for themselves, but it might be a bit messy along the way. We're looking at an 8K filing from Clean Energy Technologies Incorporated from April of 2025. This report tells us about some important things that have happened recently. Specifically, it seems they needed some cash and they got it through a deal that could significantly change things for their shareholders. The big news is that Clean Energy Technologies made a deal with a company called Pacific Peer Capital II. This deal involved Clean Energy Technologies selling a special kind of loan called a convertible promissory note and some shares of their stock to Pacific Peer. Think of it like this. They sold the right to future stock and some stock they already have in exchange for money today. So how much money are we talking about? The total amount Pacific Peer paid was about $310,500. After some expenses, Clean Energy Technologies ended up with about $300,500. They gave Pacific Peer a loan that could turn into stock later on and a chunk of stock right away. There are some rules that Clean Energy Technologies has to follow because they're listed on the Nasdaq stock exchange. One rule says they need to get approval from their shareholders, the people who own the company, before they can issue too many shares. This is like getting permission from the owners before making big changes to the company's ownership. To make sure they follow the Nasdaq rules, Clean Energy Technologies can't give Pacific Peer more than 1,250,000 shares of their stock until they get shareholder approval. This is called an exchange cap, basically a limit on how many shares can change hands right now. Clean Energy Technologies needs to let everyone know about this deal. They have to file paperwork with the SEC, the government agency that watches over companies and the stock market. They need to file something called a preliminary information statement, which is like a rough draft and then a final information statement, which is like a rough draft and then a final information statement. Now let's talk about the loan, that convertible promissory note. It has a few important details. It lasts for 12 months and it collects interest at a rate of 10% each year. That means Clean Energy Technologies has to pay back the original amount plus 10% interest each year. Here's where it gets interesting. Pacific Peer has the option to turn that loan to shares of Clean Energy Technologies stock. The price they pay for those shares is based on the stock's price just before they convert, but it's at a discount, only 90% of the average price. So it's a pretty good deal for Pacific Peer if the stock price goes up. There's also a limit on how much of Clean Energy Technologies that Pacific Peer can own. They can't convert the loan if it would mean they own more than 4.99% of the company's stock. This is to prevent Pacific Peer from taking over the company without going through the proper procedures. To make things even sweeter for Pacific Peer, they get to deduct a small amount from the conversion amount to cover their costs each time they convert the note. It's like getting a little bonus for converting the loan into stock. If you want to see all the details, you can find the full agreements filed with the SEC. Look for Exhibits 10.1 and 10.2 with this report. These documents have all the fine print and legal language. Clean Energy Technologies is supposed to use the money from this deal for specific things. They can use it to grow their business and pay service providers, but they can't use it to pay back debts to their own officers, directors, or employees, or to invest in other companies. It's like having rules about how you can spend your allowance. The company sold these securities without registering them with the SEC. This is allowed under certain rules, specifically Section 4 Eon 2 of the Securities Act of 1933. It means they didn't do a big public offering, they sold them privately to Pacific Peer. Now let's step back and look at the bigger picture. Clean Energy Technologies is a small company that needed money. They got it by selling a loan and some stock to Pacific Peer. This deal could be good for the company if they use the money wisely to grow their business. However, it also means that existing shareholders could see their ownership diluted, meaning their shares become worth less if Pacific Peer converts the loan into stock. The fact that Clean Energy Technologies has to get shareholder approval before issuing too many shares to Pacific Peer is a good thing for shareholders. It gives them a say in whether or not the company should issue more shares, which could affect the value of their stock. One potential risk is that Clean Energy Technologies might not be able to use the money as effectively as they hope. If they don't grow their business, they could end up with more debt and a lower stock price. Also, the terms of the convertible note seem pretty favourable to Pacific Peer. The discount on the conversion price and the fees they get to deduct could mean that Pacific Peer makes a lot of money if the company's stock price goes up. Overall, this deal seems like a bit of a gamble for clean energy technologies. It could pay off if they use the money wisely and grow their business, but it also carries some risks for existing shareholders. It will be interesting to see how this plays out in the future. Thanks for watching Corporate Decoder. If you found this breakdown helpful, please like, comment, and subscribe for more insights into the world of corporate finance. Until next time.